Hey everyone, this is a trader investor. In this video I'm going to talk about the demand zone and supply zone, why they work, what is driving price behind them, not how to draw them because we did that in the last video. But in today's video we're going to focus on what it means and why is it really a demand zone, why is it really a supply zone. So price is driven by institutions, not by retailers. We like to think we drive price, but we don't. We just follow. We follow, and sometimes we're on the wrong side. So when price rallies and has a pullback and it forms a base where that pullback is terminating, and we only know this after the fact, that's okay, because in the supply zone and demand zone trading, we want to see what has happened so we can prepare for a position down the road. So when we have a demand zone, meaning lots of demand is in that area, lots and lots of demand, more demands by institutions than the supply can sustain. So because demand is greater, we create a demand zone. What that means is institutions place millions of dollars into a position, but they do not chase like retailers. They have a maximum price that they want to get in at. They're not going to get in a penny more than that. So when they place a large order and the market does not have the supply, they have unfulfilled portion of their order. They place an order in the SPYs for $10 million, maybe only $7 million gets fulfilled. They still have $3 million of open orders waiting in this area. So what happens to those open orders? Well, when price keeps pushing up and comes back down to that area, that's an area we will be interested in because those open orders are going to get picked up. Once they get picked up, then price will resume in the direction it wants to go. So sometimes they leave, come back, they leave, come back again, because there might be additional orders. Maybe this time they only picked up another two, there's another $1 million of orders left in here. They pick up that 1 million and they leave. And the next time it comes here, it doesn't leave, it collapses. That's because there were no more orders to be collected here. So what we want to do as retailers is, once we understand this concept, orders are sitting by institutions to get filled, we follow that position. Same thing on the downside. Price drives up, forms a base, drives down, it creates the supply zone. And what does it do in the supply zone? Where orders that were not filled when price was driving here, when price comes back to this zone, those orders get filled again. Now, we don't know the depth of these orders, how far they're willing to let price go down. But one thing we know is, if we trade with institutions, and if we look at hourly chart or a daily chart and we want to trade with institutions, what's important is, what is the broader market doing? The broader market is in an upwardly move. The reason I created this word is because here we have some form of consolidation, but it's still making higher high, low, higher low, higher low, higher low, higher low. We're continuing to make higher lows, therefore we're in a bullish momentum, right? We're upward moving. We're making that bullish momentum. Therefore, for me, I do not counter trend. What I mean by that is, when I see a supply zone, I do not enter a supply zone to the downside. I get a nice pin bar. This is a beautiful entry to the downside, 442.99 to about the low of this bar, 442.73, right? Some 26 cents, but that's not the kind of move that I want, right? I want those dollar moves. So I'm not entering this because this is counter trend. there's nothing that has indicated to me that price is going to the downside furthermore. There's nothing that indicates there's more weakness. Now, when we look at our 15-minute range, right, something that we look at all the time, 15-minute range, and I say if price breaks above, look at the previous highs, price breaks below, look at previous lows. And that's why when this 15-minute range, for me, is a form of an indication of those demand zones and supply zones, but by drawing it out here clearly, you can see. So here we have a demand zone that has not been touched yet. Here we have another demand zone that has actually been tested. What do I mean by tested? Well, price yesterday, price did this yesterday. It reversed and formed this base. How do I know this formed this base? I didn't know that until this morning when markets open high, so I knew this pullback was over, so this base is formed. So I'm not going to go into how you draw them. Please refer to the previous video. But I used a lower time frame to kind of let me know, okay, here's my base. But even on a 15-minute chart, you can just take a look at the open to the low of that wick from this last 15 minutes of trading. That creates our demand zone. Now that we have this demand zone, price drove up, and when price drives down, I'm already waiting for this demand zone anyway, because I know price is driving down, and then I get railroad tracks. What do I mean by railroad tracks? Price comes down, the next bar reverses up at equal distance almost. This is not an exact railroad track, but body to body is railroad tracks, close enough for me to say this is a good candlestick pattern to say, hey, price is reversing. And what does price do? It reverses. So from this high to the supply zone is 69 cents. I did not enter this trade. I'm going to be transparent about this. Price moved up beautifully. I did not enter this trade. Why? Because I don't have my dollar move. I want my dollar move. This is a very tight supply zone, demand zone range. Very, very tight. Now, if somebody was trading maybe the 3-minute chart, if you were trading the 3-minute chart and you get this price come down to demand zone, price comes to demand zone, I don't see any candlestick pattern forming here that would have gotten me in sooner. I don't have any entry that is in sooner. So therefore, I don't get this dollar move even for that entry. Yeah, in the previous video, I said, please do not enter them blindly. Just because price reaches here doesn't mean you should go in and boom, because this might have been an area that there's no order sitting here. Maybe all orders were fulfilled here. There's no order sitting here. So if there's no demand, price is going to shoot through it. It's going to slice through this demand zone. That's why you don't enter blindly. You want to get some confirmation. So I don't see any confirmation. Therefore, I don't say, oh, if you had traded lower time frames, you have an entry. At least I don't see that entry. But if you had taken a chance here, of course, from here to here, you have your dollar move. But that's not how I trade. So again, the concept is when institutions place an order to buy, they don't get all their buy orders filled. They create a demand zone, price comes back down and then reverses from there. They create an order to sell, not all their sell orders get fulfilled, price comes down, reverses back to that zone, the rest of their orders gets picked up and price drives down. So price has a tendency to move from demand zone to supply zone and back and forth. But if you follow the trend, some demand zones are going to be left open, meaning those institutions are not going to get their orders fulfilled. So they might even cancel those additional orders, waiting for a major pullback, market correction, some collapse to come back and revisit. So if it's been, a few months, I'm not very certain that demand zone is going to remain, right? If we never hit this box area, 441.80 to 441.30, this 50 cents range, if we never come here for 6 months, a year, and then we come back to it down the road, I am going to be extremely cautious on how I trade this. Even with a candlestick pattern confirming, I might want to see additional confirmation, like what is volume doing, what is the overall market sentiment, what is the VIX, what is the VVIX, what is the put call ratio. I might take a look at all of that. But in general, you get the idea. Where there's a lot of demand, it means institutions' orders are not filled, so they need to come back and fill some more. Where there's supply, institution orders to sell are not filled. When they come back, they fill those orders. And the more times it comes to that area and fills orders, the less chance you have down the road for that zone to remain a zone. So if they've picked up some orders here, they come back and pick up some orders here, they come back and pick up some remaining orders here, the fourth, fifth time they come back, if there's no more order, price is going to go strike through it, right? Slice through that zone. So that's why it's important for me, one time I'll take a position. If I have, the rest of my criteria met, there's a dollar move in between, I can take a chance, and it's in the trend, the overall market trend. There's no divergence in my oscillator. I take a look at all of those conditions, and then I'll enter a position. Very seldom do I want to enter a counter trend position because the market is strong. And when the market is strong and it has pullbacks, but we don't know how deep those pullbacks are. I don't want to assume this pullback is large. I don't want to assume this pullback is medium length. I don't want to make any of that assumption. I just want to trade with the trend. So if I trade with the trend until this trend is broken, and when it's broken and it does this, then I can continue to look at just the one side. So just wanted to give you a brief overview of why demand zone and why supply zone are important in your trading and how they are made. It's not just a zone. It's not just, we form a base, boom. No, we form a base and there's orders, large orders that have been left unfilled. So when price comes back down to those areas, they fill them. And as you can see in this area, when price filled them, price took off. And they did that a few times, right? They filled some, there was some additional that they needed to fill, they filled some, and then once price took off, it took off. Now the next time it comes back here, I'm going to be extremely cautious because I know 1, 2, 3 bars orders were filled. The 4th bar might be still additional orders as they were being filled and taking off. So I don't know if I want to participate here. Even if I get this, I don't know if I want to participate unless I'm confident that the market is going in the bullish direction again strongly. Like, I want to see is my VIX, VVIX, how are they all doing? I want to see my VVIX below 110, ideally, specifically below 120. I want the put call ratio below 0.8, definitely below 1. I want to see at all of those as price moves up. So this is a video to really clarify why a demand zone is very strong, why a supply zone is very strong. Institutions have orders that have to be filled. They do not chase. That's why this video is important. Institutions do not chase. If 441.81 is their price, you give them 441.82, they're not taking it. They're gonna wait. They're going to wait because they know price is going to come back down. Retailers, we are impatient, so we say, oh, it's only 5 cents, it's only 50 cents, we chase it. But if we trade like them and wait for price to come back to this zone, we have better entries. You get a pin bar in the zone. You get a pin bar inside the zone like this. Boom, you have a much better entry than chasing it up here. Then you can have not just your dollar move, you can have $2, $3 move. All right, everyone, take care, and I will see you in the next video.